You're about to join Jerry Parker, Maurici Siebert, and Niels Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Another week have flown by, and Jerry Parker, Maurici Siebert, and I, Niels Larsen, are delighted to be back with this week's edition of the Systematic Investor series, where we try to make sense of the recent market action through the lens of a rules-based investor, as well as offering our thoughts and comments to the great questions we get from our listeners. Jerry, Moritz, good morning, good afternoon. How are you doing this Saturday in November?
Doing great. Good morning, good afternoon.
Yes, hi guys. Doing well.
Yeah,
cold.
Great.
Cold here in Richmond, so.
Yeah, it's that time of year, isn't it?
Yes.
You know, I was trying to think of something interesting to pick at for this week, but there wasn't really a lot of excitement that I spotted. I mean, the S&P pretty much finished where it started. We had a bit of a flattening of the yield curve. The VIX finished around 12.5. And gold and crude, even those sectors, finished within 50 basis points of where they started. So, of course, there was a little bit of movement in some of the commodities like lean hogs and coffee. But for the most part, I thought it was pretty uneventful. I guess most of the action nowadays happens live TV from Capitol Hill with all these impeachment hearings going on. But that's something we leave to the politicians to sort out. So with that very little intro, Moritz, I'm interested to hear if your week was a little bit more exciting than what I could point at.
Relatively uneventful, Niels, but I've made 50 basis points, I think, when I had the last look. So not much, and the bonds, they've stabilized a bit. As you know, the past couple of weeks they've been on a relatively strong move down, yields rising in Germany, in the US, pretty much around the world, in Australia as well, in Canada. And that, at least for the time being, has stopped a bit or quieted down. So the long bond positions, which I still have, not to the extent I used to have them, but are still long, they've recovered a bit. And all the other markets I found were just relatively quiet. Equities trying, they've made new highs, but it's not really like, sprinting another 1 or 2% higher. It's kind of like up there. And energies, I remember WTI flip-flopping around between, 58 and 56 and back and forth. So really not a strong trend there. Not a trend at all, really. Euro dollar relatively stable at 110.5 roughly. So really not that much of a movement. And so definitely, I've just mentioned it prior to the start of the recording. One major position change, which is the Bitcoin long, that's gone. That's history for now.
Cool. Yeah, on our side, it was pretty much as flat as you can get in terms of performance, I think, within just a few basis points from last week. It was a seemingly quiet week, of course. Equity still continuing to flirt with these all-time highs. But we did see a bit of a pullback this week. So the equity sector, inflicted a little bit of pain in our program. The softs, things like coffee, cocoa, also kind of held performance back this week. But the biggest sort of market in terms of give back was really the Mexican peso. But we saw other markets in the currency sector, I guess on the back of a stronger dollar, do well. So more than offset those peso losses. Fixed income, energies, grains were fine on our side. And actually the biggest positive contribution this week was from lean hogs. So nice to see, smaller commodity markets having a decent impact. I think overall the theme for us this month has really been reduction of risk overall, less conviction in some of the signals, certainly bonds being reduced. We've seen some, more positive signals coming out of the energy sector, so not short as we were going into the month. And stocks, obviously long, but maybe not quite as long as we were in the beginning of the month. So, nothing out of the ordinary in that sense. But Single stocks, you never know. They could have had some really interesting moves. You never know, Jerry.
Definitely some big moves in the stocks this week. It's just random that I happen to trade some of these stocks, so I don't have an unlimited universe. I pare it down to like 35 stocks. But Tesla had a big upside move, then a big down move, I guess, on Friday after doing something with a truck. I'm not sure what. Then Target, which I've been long for a while. Boring, nothing going on there. But it's a really good moving stock, and it was up a lot, $13 one day on earnings or something like that. So, but once again, they're all in the portfolio strictly based upon their ability to add diversification, like Bitcoin. And so that was a failed trade on the first try, but I'm happy that it's liquid and we can trade it. Most of the markets that I'm long are way off their highs, and most of the shorts are way off their lows. But I guess the Israeli shekel made a new high for some reason, and I've been long that for a while. Not a lot going on, but still hoping to see a lot of my recent trades have been immediate failures, so I don't really enjoy that with cocoa, bean oil, longs. So I look at these things and shake my head, so not happy.
Are you involved in any of the Schwab TD Ameritrade potential merger? Do you trade any of those stocks?
No, and Tiffany either. I don't trade Tiffany. I like to follow things like that, and it's kind of interesting to see what's going on there, and sometimes you get lucky and you get a big pop. Back in the day, I was long some stock and, strictly based on trend following. And it got a takeover bid just a few days after we bought it. And we got a call from the SEC saying, we need to ask you a few questions about this long. And we were really proud, we have this systematic approach, trend following, we buy it. Okay, that's enough. Okay, you're fine. Move on. So they weren't that interested in hearing how we got long.
Sure, no. I read somewhere, I saw an article that if they are allowed to merge, they would end up with something like 70% of the RIA custody or something like that, which seems pretty high nowadays with all these rules about competition. So time will tell.
I've been a guest every now and then, maybe once every other month on the TD Ameritrade TV show. And so it's really fun to be on that show and talk about the markets and try to figure out a way to throw in a little bit of trend, but have, I guess, some fundamental views as well. So we'll see what happens with that organization.
Sure, absolutely. So not so much happening in the markets, as I'm sure everyone can tell, but it doesn't mean that Twitter necessarily was quiet. Who knows? We could have made a new high on some of the tweets. So what golden nuggets do you have for us this week, Jerry, that we could dig into? We've got actually quite a few questions as well. So hopefully it'll be super exciting today with all the themes that comes up.
Yeah, I mean, I had a lot of things I was interested in this week, more so than maybe other people were interested in them. But there was a good article in the Financial Times about picking stocks, how quants and QE shook the cult of the stock picker. And of course, I'm not a big fan of the concept of stock picking in general. But my comment to the article, my first one was, it's the system that creates the profit and the edge. It doesn't matter much if the stock is a good one or not. Then I quote the article says, it looks like no manager can pick stocks anymore. He believes being an active manager is a dirty term now. And my comment was, no one can pick, that is, predict, and no one ever could. So that got a lot of interest, and I feel like from our point of view, systematic trend point of view, we don't look for these markets to add value or an edge, or mostly for diversification, that we include them, and then we expect our model to transform these markets into something that's going to make money for us.
Indeed. I'm not so sure I have any sort of real thoughts or comments on that. I mean, it is the continuous battle we have. People tend to prefer the experts that go on air and make their predictions compared to people who kind of ditch the story and play the odds instead, which is what we do. So, yeah, I mean, we'll see if that ever changes. Who knows?
Was this the Buffett article? I read an article on Buffett in the Financial Times this past week, or I skimmed over it, where it said that, somebody had recreated Buffett and outperformed Buffett by picking cheap stocks, with low PEs and systematically doing that. Is that the article you're referring to?
I'm not sure. Maybe.
Okay. Well, I would agree it is the system, because if you follow that system and you just stick with it, then you'll have, a bunch of bad trades in there and you have a bunch of good trades in there. But it takes the emotion out. And I think most of the drag from anybody that believes that they can pick anything or predict anything is, there's a emotional drag because you get attached to a certain stock and you end up making the wrong decisions. Holding on to losers and selling winners too early. That is the major one, which is so easy to do. And if you have a system that avoids doing that, then I'm not surprised that it outperforms those people.
Yeah. And I think trying to have an approach, whether it's systematic or not, that's going to pick the right markets, I think it's much harder and probably almost impossible versus setting the markets and then having the system know when to get in and out of those. And I think that's just something we should emphasize, that just like we don't try to pick cocoa or we don't try to pick the Swiss franc, these are the markets to trade. They're part of our portfolio, and our system will tell us when they're good markets to trade. And then we don't really need them to be good markets. I mean, Enron would have been like the perfect stock for us. Horrible stock, but a great trade. We buy it on the way up and we get short on the way down. So you got that element as well, the shorts as well. I think that it may come as a surprise to some people that I think trying to be a stock picker is predicting. And, no one believes you can really predict. And sure, it doesn't work. Sure, it's hard to, I don't know that it's ever worked.
I mean, I guess to the other point to that is really that, when you look at people who do their equity research, I mean, even if they had pretty much perfect information about how a company is doing, I mean, there is no guarantee that they, that they can guess which direction the stock and how it's going to react. I mean, that's the other thing on that. But I think speaking about picking markets, Maurici, I don't know if you want to talk a little bit about, because you said you've actually picked a market this week to add to your portfolio. So I thought that could be interesting to hear a little bit about your thought process and why you decided to add another market to trade.
Yeah, I'm happy to report that. I've added Singapore iron ore to my portfolio. So it's iron ore traded on the SGX, that's the Singaporean exchange. And I've been looking at that market for quite a while, a couple of months, and wanted to see and observe liquidity and spoke to brokers, like how do you trade that? When do you trade that? Which session do you use to trade? How does it settle? Like, it's just kind of like finding out the nuts and bolts of how that market works. And then, I looked at the behavior of that market, or, what it could add to my portfolio in terms of diversification benefit. And it turned out, at least for me, that it is a nice market to add to the portfolio. I mean, it does have positive correlation to some of the other markets, such as, for instance, copper every once in a while, right? But it is still uncorrelated enough so that it does add value to the portfolio. And then it was kind of like a no-brainer to just say, you know what, let's go, let's do it. The system can handle it. I can produce the orders. I can send the orders out. I can work with them. I can reconcile them automatically, import them into my system. So really, there wasn't anything speaking against adding that market. And if it diversifies my portfolio even more, it's liquid to trade. Why not?
Is there any kind of correlation level you're looking for before you say, yeah, that definitely adds value to my portfolio?
No, I don't have a hard level saying that, if it is correlated by more than 0.75 or so, then it's a no-go. I may add a market if it's 0.8 correlated to my portfolio, and it may get a smaller weight, in combination with the markets that have high correlation to it. But I don't have a fixed rule. So there you go. There's the discretionary element, right, that we all have. What market do you add? Why do you add it? How much risk do you give that market? And so forth.
Sure, cool.
And then when the 0.8 changes to 0.4 or 0.6, then what do you do? Yeah, so we've talked about this before, how it's very difficult to figure this out in a systematic way because things can change. And then do you change? Or do you say, no, I think it was 0.8 or it may come back to 0.8, so I'll just leave it the way it is. So I find that a big puzzle.
Yeah. But thanks for sharing that process, Moritz. Very useful. What else happened in Twitterland, Jerry, this week?
Well, there was a paper I saw from, I think you sent it to me, Niels, a few weeks ago, and I finally got around to it. And I don't think we've talked about it. It's a paper from Abbey Capital.
Sure.
Talking about CTA trend following performance has been below long-term average levels recently. But they say the returns have not been outside standard statistical expectations, and we've seen difficult periods in the past. Historically, major market trends have tended to occur episodically, with several major moves occurring in some years and relatively few in others. The lower number in recent years may just reflect normal statistical fluctuation. So kind of a similar results from other papers we've seen that basically are saying that long-term trend following from CTAs is alive and well. Recent performance or lower performance is due to the lack of major market moves. And they go on to say, if market moves had become quicker, one would reasonably expect faster systems to show better performance in recent years, but they find no evidence of this. So they're not advocating slower systems now that we've all, or a lot of us, have gone to longer-term systems. That's not going to help either. That hasn't looked any better. So I guess we stick with what we're doing, and it'll turn around and look like the past, hopefully.
So I have an interesting point to share there, and I gave Niels a call earlier this week to inform him about this. I'm not going to mention any names. That would be appropriate, but this week I had a meeting with a very established systematic trading firm in Munich, and we, started to discuss trend following and recent performance. And there was a senior researcher there, and he said it is for them like almost a certainty that trend following returns have decayed and that they will decay going forward, and that the future Sharpe ratio that you should expect from a systematic trend following system will definitely be lower than they have been in the past, and that trend following therefore does not warrant as high a risk or capital allocation added as it used in the past, based on, the last 100 or 150 years, which they have examined over various trend speeds, all sorts of things, and very adamant in their conclusion that, this decay, this degradation of returns is there. It's not a statistical fluke. It exists and it's not going away. And that's that. And I then kind of countered that with, saying, well, for instance, the paper from Abbey, even though I didn't use that as an example, and there's other studies that we all know on the historical performance of trend following, and that even if you look back 100 or 150 years, there have always been those episodes where it hasn't worked that well. And you could look at, some of the CTAs with long-term track records, such as, for instance, Dunn or, Chesapeake, and look at their returns. And, Niels, you were saying multiple times on our podcast that, in fact, your returns have gotten better in the past couple of years and they haven't degraded. But they kind of they discounted that completely. They say, no. This is maybe then just one observation, but they're standing by their observation that trend following is getting worse, the performance.
Yeah, I think it's an interesting view to take, and of course we're all entitled to our different opinions. We base our conclusions on the evidence we see in our trading, and as you rightly say, we certainly have been able to improve what we do. So research does play a role. Maybe we have the benefit of not being a mega CTA. I'm sure that has something to do with it. It's like saying that just because you have a decade of low return, let's take a real example. Equities, if we use the US equities as the example, they were down 12% from January 1st, 2000 to the end of 2009. Does that indicate that equities should not make money in the following decade? Well, we know now that they made tremendous amount of money in the following decade. So just because you have a decade of lower returns, I really don't think that you can say conclusively that means trend following is not going to work in the future. I mean, without a doubt, I think it's true that the 90s were an incredibly strong performance decade for trend followers, and maybe we won't have exactly that environment in a specific decade, right? It could still be over a 5-year period or 7-year period. But I just think I think it's a little bit silly to make these conclusive forecasts. Frankly, I mean, nobody knows the future, and why should they be the exception? That's just my view.
Yeah, I would have really liked to know exactly why they say that, because I think that there's some legitimate reasons that could definitely be true. And I think the scariest one out there is that the short-term traders and the algorithms are targeting CTAs and creating more false breakouts, and then setting off an avalanche of selling, like in the bonds we had this year. And so that's going to play havoc with the return. So when we get the trends, it's going to be difficult to capture the percentage that we used to capture. And then we get a lot of more false breakouts. And so I mentioned on the podcast that, anecdotally, every trade I put on in the past few weeks, it's immediate loser after I get my full position on. And so, so I think these things can happen, and they're no fun, and that's a really good thing to predict, and it might be true. And but I do think that if on the back of all of these reports that says, well, basically, no, that is not what we've seen from AQR and from Abby, and I think at least one or two other groups, it's just a lack of trends, then okay, then go ahead and predict and let us see evidence that that specifically what you're saying is we're not going to see these trends any longer. We're just not going to see them. The ones you've seen in the commodities, you haven't seen in a while, you're not going to see them in the future. And so, okay, that's good. Then why? Why do you make this claim that we're not even going to see them? You may not make as much percentage on the big trends that you used to. You may have more false breakouts, but look, you're not even going to see those trends like you have in the past. And that's really, I would even say, Achilles heel of trend following, but it's way bigger than the heel. It is a big, huge assumption that we are going to see these big trends like we've seen them that are going to pay for all these small losses. And so why? Where do you come up with this idea that we're not going to see them? There's something now fundamentally baked into the cake that the power of the central banks maybe is going to remain and increase, and they'll knock down the commodity trends and inflation. So that's what I'm more interested in. Not the claim, which I definitely think it's definitely possible, but how about the reason that you make the claim?
I think there's a couple of interesting things to dig into. I mean, first of all, I very much like the paper that Abbey Capital produced. I think they deal with some of the arguments that has been put forward as the reason why trend following have produced lower returns in the last few years. But I think they deal with them very elegantly, and I think they produce a decent amount of explanation / evidence for why those arguments don't seem to hold up, such as CTAs are too, the community of CTAs are too large. I know it's difficult to completely say accurately how big is the community, because people could still be using trend following approaches but not be a CTA, and therefore it's a little bit of a problem. I also like the idea that you mentioned, Jerry, that there's no evidence that shorter term strategies are doing better if the markets have changed. So, the Trump tweets are producing shorter term moves. There's no evidence to suggest that shorter term trading has been more profitable. I actually do like the idea of there just being smaller movement in GDP across the world, meaning that central banks, politicians, or maybe just luck has left it with a decade of relatively stable economic growth, which certainly in the financial markets that we know a lot of the bigger firms have large allocation to, there has perhaps been one smaller big moves. And also when they do turn, maybe they turn a little bit quicker, not because that there is some conspiracy against trend following, but maybe more because the economies for a period of time have been quite coordinated. They've, they've been in sync compared to maybe the last or the previous 20 years, where there were more divergence in the economies. Asia was doing one thing while Europe was doing another thing, and the US was doing a third. Then suddenly they all came together after the financial crisis. They were using same policies and then created a more coordinated economic rhythm, so to speak. But I don't think if we look back that is unusual, that you'll get these periods where economies are, going up and down more or less in tandem, so to speak. And if we look at that data, it just seems to me, or not necessarily the data, but it just seems to me that there is more divergence now. We're now seeing different types of problems and policies being put in place in Asia, in Europe, and the US. So, you could argue that might give more opportunities in the future. And then the final thing we should maybe not completely discount as well, and that is we always talk about how trend following strategies in general produces better returns on the long-sided trades. And if we look at the commodity sector to a large extent, they've been short for quite a while. And so I don't know, I'm not saying that this will hold up with any, but I think directionally I'm right in saying that maybe a big part of our portfolio has not necessarily had the opportunities that we would like them to have. Again, it doesn't mean that commodity prices can't go up for the next 10 years, but we know when you look at the big cycles of commodities, they tend to, over 30 years, spend 20 years going down and 10 years going up. That, look at gold, for example, and go back and you'll probably see that. So anyways, just a few thoughts.
And then one of the things Maurici said, which is interesting, is the Sharpe ratio will be lower, permanently lower, and it's not worth investing in. But I kind of wonder, a portfolio that uses a systematic trend following approach and it trades currencies, commodities, stocks, and bonds, long and short, is that Sharpe ratio going to be worse than the world's most popular investment, which is long equities? And so that, it may be lower. It may not be worth a large allocation, but it's probably going to be worth a larger allocation than allocating to equities, which is what most people do. And I did have this one tweet that may fit in well here. It's from Morgan Housel. And it was this week, and he says, "It will be right one day, but, quote, returns will be much lower in the future," unquote, has been a constant thing for 10 years, during which the market tripled. Return expectations should be kept in check, but so should forecasting humility.
Yes.
Absolutely.
And I just get a feeling, I've been in these meetings before, where these guys come in and they have they don't trade. They don't have a strategy necessarily. They're evaluating managers, and they just love to sit there in front of the trend followers after low performance and just give it to you. So I just hate those kind of meetings where they're just teeing you up to tell you that everything you believe in is wrong. It's really no fun.
I mean, we know, of course, that in this case where it came from another manager, of course, people will take notice if a big manager comes out and saying, well, we don't think trend is going to do that great. But, very often there's a reason why they come out and say that. And then they have something else in their portfolio that they think is the greatest thing, that people should invest in. So I think we all have to take everything we hear with a little bit of a pinch of salt and let the evidence, people are smart enough out there. Investors are smart enough out there to find the managers who still produce the returns that justifies the fees and so on and so forth. I mean, if a manager for different reasons are not able to do so, that's fine, but it doesn't mean that they can predict that everyone else is going to be in the same boat.
Exactly. And that's what we just said, earlier in the podcast, is nobody can predict anything, right? So you could say, just, imagine for a second, I'm not saying that I know, I'm just imagining, that maybe there's outflows of those bank-driven QIS trend following, like the naive, or not, don't want to call them naive, but the copycat type of trend following systems. Nobody knows, like you said, Niels, how much money there really is that is traded in a trend following way. Maybe if, performance stays as it is, there's outflows there, right? And the entire trend following space lightens up. Maybe interest rates rise and central bank policies become more divergent again. And who knows, in 5 years' time, this is a completely different environment in general, overall, for financial markets and for trend following. And we're back to 0.5, 0.6, 0.7 Sharpes. And I'm fine with 0.5. And I've said that before, right? And then so, the discussion that I just had this week is then kind of like obsolete because it just turned out to be different. So I don't know. And I'll just continue trading the thing because I have no evidence that I should not be doing that. As of today, I do not have the evidence that I should stop trading my trend following trading system. And neither, to their credit, they're doing it. They're just saying, like, in competition with all the other systems that they trade, also mechanical or systematic trading systems, trend following doesn't deserve as much of an allocation or as high of an allocation any longer as it used to in the past, because the other systems that they've come up with and which they trade live have higher Sharpe ratios and higher expected Sharpe ratios, they say, and therefore trend following needs to take a back seat. But it's been quite clear in this conversation that they're a firm believer that, what they have observed over the past 30 years, a constant decay, not only over the last 5 years, but like an ongoing degradation of, Sharpe ratios for trend following, and that they're sure it's not going to stop.
I would be a lot more impressed if they would have predicted this before it happened.
Exactly. Exactly. That would be so nice. Exactly.
I mean, come on. And then how, what's your first thought before those words come out of your mouth? My first thought is, before anything, well, it may not sound like it to people who listen to this podcast, but when I'm more calm and I'm in front of people, your first thing that you're thinking about before it comes out of your mouth needs to be, am I going to be wrong on this? How is this going to, what do they say? How is it going to weather, or how's it going to, what's going to happen in the next few years with this statement of mine? And so in 2008, with the lost decade, now step up and tell me the market's going to go from that low to where it is today. Don't tell me, well, now we don't think that stocks are going to do well in the future because they've had such a bad decade. You can't rely on stocks anymore. No, step up when it's the worst possible. And, just it's pretty easy to be pessimistic at the lows. And that's, I don't know, just no shame, no humility to, I don't think that's, now's not when you want to be predicting bad things for trend and CTAs.
No, and you never want to be predicting them to begin with, right? But it's just been it's a good it's been an interesting conversation. Like I don't mind having had it. It's just there is no winner. There is no debating contest, and one person leaves with the evidence, and I've won the argument, right? But it's a different way of looking at things. They've said, like, even this year, with returns relatively good for the trend following space, as they say, it's probably a statistical fluke. It's one of those outliers, and there may be more good years in the future, but then there'll probably be statistical flukes.
It's a great conversation. It's an important one, I think, and we need to hear all sides of the thing. But equally, there was an analysis out, and I forget who it was, but there was an analysis out this week saying, oh yeah, but CTA returns are generally mean reverting. So after a bad quarter, you should basically buy the CTAs because the next quarter, based on all the evidence, is usually a strong quarter, right? You could say exactly the same, probably about a decade. Say, okay, if you have a low returning decade, probably the next decade will be, above average. But I also came across this week a long form interview with Ray Dalio. And I don't know exactly the quote, but at the very end, he was asked by the interviewer, what was the real key to his success, and basically he said is not knowing exactly what was going to happen, and relying on just the fact that you diversification across all sorts of things and not trying to predict anything in particular had stood him incredibly well, and so I don't see if it works for him, why it shouldn't work for other people. We've never advocated anyways that people should put all their money in trend following.
Oh, I have. But I do think one thing I think I disagree a little bit on with you, Niels, is that it would be kind of a bummer if you had to be so good at this that, that's the only way you could eke out a 0.3 Sharpe. So I do think I think one of the hallmarks of trend following is it all works, and it's hard to screw it up. Okay, so maybe Dunn and Chesapeake can do it better, and Moritz. Okay, we've had lots of experience in training and smart people working with us. But my gracious, I'd hate to see a situation where Dunn and Chesapeake, you can expect those guys to eke out a profit and make money with trend following, but no longer is taking small losses and going with the trend and following prices, letting your profits run. It doesn't work for anyone else. And so I don't look forward to that particular period. And I do think that would be a major come down from where we are now.
Sure. I mean, I don't know if I've said anything to that effect, but no, I mean, I think the philosophy of trend following is alive and kicking. There's always going to be some people doing it better than others, but that's fine. That's their job. That's the research that they deliver. But the principles, and I think that's been evidenced for many decades and maybe even centuries, that the principles are as valid today as they were, decades ago. Alrighty, that was a good little discussion from a tweet and a conversation on your side, Moritz. What else have we got going for us today before we jump into some questions?
Well, I didn't enjoy all that, so let's try to change the mood a little bit. But I found a couple of good quotes, and just randomly on trendfollowing.com, and they come from Ken Tropin, which I like them, and I don't know that I'd heard them before, and they got a lot of interest from my followers. So let's just, I'll read these quotes, and then we can chat about them. The first one is, the nature of data is it changes a little all the time. The key to success in systems trading is to have a loose-fitting suit. I can't have a suit that's so tight and perfectly proportioned to me that if I gain 2 pounds, it won't fit anymore. And so that's another favorite topic of mine is, and kind of what I was saying earlier is that, my suit and Dunn's suit and Mauritz's suit, are they the only suits that are going to work? And I don't like that idea. And then also my suit needs to be more loose and not so predictive and fitted to the historical past. And I think that's what he's trying to say. It's okay if you have these drawdowns. It's sort of a sign of robustness, and you're not trying to get too much out of the historical data.
You have to be able to wear that suit to every occasion, to a wedding, to a meeting with a lawyer, for breakfast and all of that. That's, it needs to be your all-round suit that works throughout time. It also must not be a very, very horrible and terrible suit, because then your system isn't any good. But it's what we're saying all the time about robustness. We cannot, curve fit, or we must not curve fit our systems. And it works because we have this robust, loosely fitting suit, which isn't too precise and too smooth, and we just go with that. And we're not embarrassed to wear it.
Yeah, and I had another tweet that kind of fits in here. It's from an article about alternative data and AI and machine learning. And it's kind of sort of how we kind of don't like that stuff, because it's adding more precision. And we just got finished saying we don't want to be too precise. We don't want to have a smaller sample size. And the quote I pulled from this article is, this data that we offer can be an additional input to either help you confirm or falsify convictions. Think of us as an additional feature within your model. And then my comment is, more data can weaken the model. So we don't want more data and more precision and fewer historical trades to look at. We want more trades to look at that are less precise, that are going to fit more in the future with crazy things that are going to happen in the future. The fundamentals are not going to be similar. And it's going to have maybe bigger drawdown. So it's a whole different worldview of investing. More data or less data. I'll take price only and what comes with that versus, what these alternatives are. And maybe that's what your friends were saying in this meeting, is that you're going the opposite direction. If AI is going to work and machine learning is working, and we're going to get better and more accurate and more precise with lower drawdowns and more better trades, then how can trend following keep working at the same time? I think it probably can, but we're going to be slow to give up. I am.
I went through another behavioral finance book this week. I really love that that area of finance, and I think there's a couple of great guys out there. Daniel Crosby I've mentioned a few times. Brian Portnoy was the book I went through this week, and a lot of their research, of course, is done based on very long periods of time, studying humans, etc., etc. But what always comes across in these books is that it is wrong to believe that more information gives us the ability to make better decisions. I think most of the evidence is that it's the contrary. So yeah, I mean, I completely agree with what Jerry says, and but again, we as humans have this tendency to believe that if we know more, we can make better decisions. I'm not so sure that is true.
No, I mean, it's absolutely not true. I do think that sort of the thing that I get a little nervous about with behavioral stuff is that I don't want to be in a situation where I'm the only one who can do it. And I think to some degree, that's sort of where it rests, is that as long as there's not too many people who have the backbone and can withstand human biases by creating a systematic approach and following it, then it could continue to work. But I think that's another issue with us, is that if I'm not the only person, and then we're not the only people. And so there could be one of these days a majority of people who embrace systematic trading and not put themselves in the same situations we do and have, and it could be less profits for everyone when everybody gets more systematic and disciplined. So.
But you know what, Jerry? I mean, I think it's a good point you mentioned, but I think the reason why that will not happen, and obviously that is a bold claim to make, but I think the reason why these behaviorally based strategies will probably not get overcrowded is because they're so damn hard to do. Who wants to be put through what we're going through in terms of drawdowns and volatility when you can choose to go into a strategy that just looks smooth and low risk, et cetera, et cetera? I think that's where most investors will seek to find their profits. And that's exactly what's going to leave us in our little field to do what we do and continue to do it, not in a straight line, difficult at times, but profitable over the long run.
And embracing commodities, for instance, like
right.
This horrible period of short trades. And I was thinking, what's our last big commodity trade we've had? Short energy, 2014. So even when we've had one that set us apart and we crushed it, crude going from 90 to in the 20s, it was still a short. So so embracing markets, which I think we have no trouble doing, that have not performed well recently or in the past 5 or 10 years, is a huge edge. And now continuing to embrace a strategy that hasn't done as well as just long equities. So it's a two-part thing. It's equities only, and it's the strategy. Both have not done as well. So, yeah, I think that's a huge edge, continuing to not fight the last war. And it leads me right into another, just like we planned it, which we didn't, but maybe the final tweet, I guess, of the week. And it's another one that comes from Ken Tropin on trendfollowing.com. He says, most long-term trend followers are doing something that is difficult to do discretionarily. That is, wait for a market to make a new high price and then get in. It's never, I bought this right. It's usually, I really bought this wrong. So that's the way I feel about my lead, cocoa, bean oil, and etc. So I've really bought that wrong, and the market didn't just take off after I bought it. So it more painful than that. But you're right, and that is very helpful to have some pain and suffering.
Absolutely.
And sometimes it may be the other way around, right? You got out of your Bitcoin and it looked wrong to get out at the time because it rallied afterward, and now it looks good to have been out of the thing. We just don't know.
And the answer is always to avoid these market pattern comments. They don't mean anything. When this happens or that happens, or I'm unhappy, and it's basically you're not going to do anything until your exit gets hit. You're not going to do anything until your entry rule gets hit, and that's the rule. And whatever else we sort of see in patterns or we dislike about the markets, and we think this is what works or doesn't work, and this is a characteristic of a good trade or a characteristic of a bad trade. None of it really matters, or it shouldn't matter until the stop loss or the exit or the entry gets hit, and then we do something, and everything else, just try to ignore it.
Indeed. What we won't ignore is the questions we get from our I was about to say investors. I meant listeners, well, some of them could be investors as well, I guess. So in any event, if you want to continue to send us your questions, comments, by all means do so. Send it to info@toptradersunplugged.com, and we'll be very happy to try and answer them as quickly as we can. So first question, we have to go to the other side of the world, to Singapore. Derek writes to us. So Derek, it's a long email, so I'm just going to give a little bit of content. He has recently moved to Singapore, and he's the only kind of systematic trader in that firm now. And he's constrained in terms of the number of markets he trades. So the first question he has is, how can you adapt trend following to a constrained universe? Do you add more strategies to the portfolio when you have a small number of markets? And then he goes on to ask, how do you educate your fellow PMs, bosses, teammates on what you do when their trading mindset is classical, discretionary, and fundamental? And then he very kindly ends up by offering to help grow our little podcast in that part of the world. So, Derek, we appreciate that. Anyways, let's take it step by step. Small number of markets that he's allowed to trade, wanting to expand. I guess the answer is more strategies, but love to hear your thoughts as well. And, of course, what's the best way of trying to educate people who come from the discretionary side of things to embrace what we do? Any thoughts, Moritz? You work in a big shop. I'm sure you come across people who maybe are not as strong believers in what we do as we are.
Yeah, I show them the evidence. I show them track records of like yours, 45 years in length, and that's something interesting to look at. And many of the other track records too. And there's a lot of material out there on the web. All those great books, The Rule, Larry Hite, all of that. I mean, there's tons of information and evidence about the way we trade and its advantages. So I'll speak to them. I'll tell them my opinion, and I'll inform them of my views and why I think it's a great trading system. But I also tell them that they shouldn't just listen to me and, take my word for granted. There's objective and independent sources of information that will, más or menos, tell them the same thing. And then it's really up to them, to do that or to not do that. I can answer questions and educate them and tell them roughly how, the trend following trading systems work. But it needs a kind of openness on the other side as well. I've sometimes come across people who are so firm and close in their minds because, they've always been, fundamental macro traders or whatever, or fundamental stock pickers, that they will never turn around and even consider anything than their own strategy because they're so in love with what they do and they wouldn't jump across the fence or look any other way. So that's that, but maybe more to the technical question at hand here with the constrained set of markets. it's unfortunate that it is the case because, as we all know, the more markets you can trade and the less correlated or the more uncorrelated they are, the greater the expected return of that system. So, Derek, if there's any chance that you can have a discussion with your colleagues and convince them to expand the set of markets that's available to you, that would be a fantastic thing. And that would help a lot. If you cannot do that and you want to continue trading your trend following way, then off the top of my head, I can really only say, well, try to diversify as much as you can with your time frames. But you're not going to get as much out of that compared to the diversification benefit that you would get by diversifying across markets. So this is the little asterisk I would add to that. It will help you a little bit, but not as much as it would if you added more markets to the system.
Yeah, not a lot I can add to that. It's, the markets are the heroes. They're the ones that are going to make your profit and hold on to them as long as you can. And then they're the best and most robust way to limit the drawdown and the standard deviation and the risk in a portfolio by just applying a robust system over as many markets as possible.
Yeah, I mean, the only thing I would add to that, because I think Moritz said it very elegantly, is that, we always talk about us having to prove that systematic trading works, even though all the evidence suggests that. So sometimes I think it's fair to ask the people who are against it to prove that it doesn't work and it doesn't add value to your portfolio. I remember a conversation I had with Alex Graserman at ISAM a few years back. It's on the podcast. It's a kind of a mini roundtable. With Katie Kaminsky and Roberto Osorio from Don, and Alex shared a story which I think is a great example. And he was basically challenging in a client meeting someone to basically say, what assumptions are your investment committee making in order to get the conclusion you should have no trend? I mean, in his view, from what he said, well, the assumptions would have to be either the trend following consistently loses money or the trend following is consistently very highly correlated to what you have already. And both of those things, we know, if you pick the right manager, is not the case. So sometimes I think it's fair to just challenge people's view and say, well, show us the evidence that suggests that we're wrong. Because there hasn't been a white paper ever written to, as far as I know, that doesn't confirm that an uncorrelated investment strategy like trend following can be beneficial in a traditional portfolio. So,
and trend followers who trade systematically and believe in trend following have made the two classic mistakes of trading, which is not taking small losses and getting out of profits too quickly. And if we've done it, oh my gracious, what do you think discretionary people have done? All you have to do is just ask them, have you had an issue with that before? Oh my gosh, yeah. I've done it so many times in meetings like, this is the heart of what we do. Have you ever had these issues before? People who don't use systems. And they're like, oh gosh, I'm always getting out of my profits too quickly and leaving money on the table. And sometimes I'll let small losses turn into big ones, and it kind of devastates all my good performance. So I think just through experience, people will be honest with themselves and know that they have had the same issues that we've had. And we would continue to have if we didn't trade by the rules.
Yeah. So from Singapore, we go almost around the globe to South Africa, which is, of course, the beauty of a podcast. We have a global audience, and we appreciate that. So this time we go to Jonathan from Cape Town in South Africa. Jonathan describes himself as a swing trader, so not necessarily someone who has the same style as we do, and the same holding period and so on and so forth. So the question, so I now quote from his email, the question that I have are, one, sample size. If we were to assume a sample size of 5,000 for a given system, that means, to my mind, that a figure in this ballpark must be generated across hundreds of markets, with even with 20 or 30-year backtest. And this would have to be for exactly the same parameters of that system in order to count as a single sample. Am I right about this? More or less. So I think the question is whether or not you have to have the samples have to be exactly from the same system. to count as part of your sample size. But I think when we talk about systems, we may refer to systems, but it could be different, slightly different, obviously different time parameters, et cetera, et cetera. So that's part of why we can generate decent sized sample sizes over a 20 or 30 year backtest. Any views on that?
I think he's right on. It's 5,000 from each system. So, yeah, if we use multiple systems, then each one of them needs to have that 5,000. And I thought he was going to go someplace else and say, well, all the markets are different, though. Well, that's what we're doing. We're saying we're going to trade the same system, the same that has entry, exit, stop loss. Hopefully, not too much more than that. And we're going to trade it over all the markets the same way, and the longs and the shorts, so we can capture all that sample size and say, okay, system 1, 5,000 trades, system 2, 5,000 trades, or whatever the sample size is. And so that's what we have. But some may stand up and say, well, currencies are different than commodities. And so I don't buy that assumption of yours that if you just trade them all the same, you can say, well, that's sample size. And then some may say, well, shorts are different than longs. And so there's all kinds of possible disagreements. I'm just saying that's what we're doing. And so like it or not, that's how we get to we increase our sample size.
So let me move on to you, Moritz, for the next couple of questions that Jonathan also had. He says, in sample, do any of you follow a process to reserve a subset of the data for an in sample and another subset for out of sample? And then he goes on about optimization. Optimization with time, from what I can glean, as a kind of optimization, the same system is traded with different parameters, e.g. system 1 through system 10. Do you also think of changing the parameters for a single system over time, something like a walk forward window? For example, for say 1 year, the look back used 120 days, and for the next year, it was 97 days. Would love your thoughts on this. Okay, Jonathan, let's see what Moritz has.
So the last part of the question is an easy answer for me. That's a straight no. I'm not. Well, first of all, I'm not using the walk forward analysis, and I also would not allow my time windows to change based on that. So no, the answer here is a clear no. And then as for the in sample and out of sample question. So I do reserve a bit of data for out of sample testing when I design trading systems. And I must immediately add to that I have not yet found that to be I don't have the evidence that I'm really gaining anything by that. I have picked up that it's, good statistical habit to do that, to design systems that haven't seen all the data so that you have greater odds of improving the robustness of your system by not feeding it all the data. Maybe coming back to that loose suit, maybe the loose suit that we're trying to fit to the data is so loose that it doesn't really matter if we have the system look at all the data and just, get to the full sample size, which Jerry correctly said is so important to have this large sample size, and then just feed it as much data as you can and design your system, because we know, what we're doing there is we're not trying to, be too specific and too detailed and laser pointed about those things anyways. So I cannot really be here and defend that you must reserve 25% of your data for out of sample testing, and if you haven't done that, then you're doing something wrong. I cannot say that. And if you, so like me, I've done that. I still do that. It opens up a whole bunch of other questions. You could say, well, Moritz, why are you reserving the last 25 or the last 30% of the data? And you make that data unseen to the system. Why not the first 25 or the first 30%? Why not something in the middle? And why don't you mix it up and you you leave 2 years out in the 1990s, and you leave 2 years out in the 2000s, and you leave 4 years out in the 2010s. And there is just no answer to those questions. Because if you had an answer to those questions, you could say that you believe that more recent data has greater importance or more value to your system than earlier data. And I think that's completely wrong. So I think all the data is valuable. And so for the way that we trade, I would just say, you know what, I'd be as fine if you just feed your system all the data. And if you, like me, you think, well, let's just be curious and be surprised, and you leave the last, 30 or 25% off, and you make that auto sample, that just works fine too for our type of trading systems.
Well said.
Yeah, I don't have much to add to that either. I'm not sure exactly where in the world our next question comes from, but it's from Indrius, and might not have pronounced that completely correct, but let's run with that. So the question is, and I'm not so sure whether it could be the right question, but let's see. You ask how much risk to take, 15 basis points, 20 basis points, 25 basis points, for example, per ATR, but I'm not sure that that's exactly how we look at things, risk per ATR. So let me turn that over to our experts on ATR, Jerry, Moritz. Obviously the follow-up question is that if you have more markets, you take less risk, and I think that is per market, and I think that is true. But anyways, can you talk a little bit about this kind of how the risk fits into ATR?
Yeah, it's. I don't think I can do much explaining on a podcast, but it's definitely the ATR movements are going to tie right into the percentage movement in your capital, no doubt about it. That's the way I do it, and.
But what you do, Jerry, though, if I understand it correctly, what you do is you measure obviously where your stop is going to be in terms of ATR, but you're going to risk 25 basis points, for example, regardless whether it's further away or not. It's just a matter of position sizing and whether you're going to trade X number of contracts, depending on the closeness of the actual stop, right? The risk will be the same. That doesn't change whether you have a 5 ATR stop or a 3 ATR stop on that particular trade. You're still risking the same amount of risk?
Oh, probably not. Yeah, probably not. Because it's just hard to explain. I think that ATR is tied in to everything, and it's definitely tied into the number of ATRs you may give a trade, before you get out is one way ATR works. And then the movement of the markets every day is going to be correlated to the ATRs, and I'm looking at that in many different ways, and the placement of your stop 2 ATRs away is pretty close, and your winning percentage is going to be lower. So it's not a free lunch. Oh, I'll risk less versus an ATR that's further away. The ATR that's further away is better and less risky possible because the close ATR stop is going to give you a lot of losing trades, way more losing trades. So it's not this even trade-off all the time. So it's a little more complex to talk about it during on a podcast versus a live event where we can get into it like we did in New York.
Very true. Very true. Anything you want to add, Moritz? Or
not much. I think that what I picked up is I'm not risking a certain percentage of ATR. I'm risking a certain percentage of my equity.
Right.
And I'm using the ATR to figure out, what position size I need to have on in order to risk exactly that amount of my equity.
Yeah.
Yes. Perfect.
Yeah.
I guess you can't explain it on a podcast.
But not as well as on the live event, that's sure.
Yeah, okay. I just can't do it, so thank you.
All righty, let's move on to Brian. Brian has send in questions before, so nice to see another one from you, Brian. So Brian refers to a conversation, actually probably the same conversation I was referring to before with Alex Grayson, and he talked about pensions and endowments and how they can construct a diversified portfolio managers using 3, 4, or 5 different trend following managers. So Brian asked us to talk a little bit about this topic. Maybe the question could be, how many trend followers do you really need in a portfolio? I'm not sure, Brian, but so we're going to have to freestyle this a little bit. And then also you go on to say that both I and Jerry have mentioned, and I'm sure that goes for Moritz as well, that we are long-term trend-based. And then you ask, how would you seek out other managers whose funds would be a good complement to yours? Is this something that would be difficult outside the pension endowment fund managers? Moritz, do you want to talk a little bit? I mean, you look at other managers from time to time, so maybe it's a good place to start with you in terms of if you want to build a portfolio of trend followers, what would you look for in difference? And then if you want to go outside strictly long-term trend following, what would you look for to add to that portfolio if you're not a pension fund or an endowment, so to speak?
Yeah, let me answer the systematic trend following question. And so I am personally invested in some other CTAs. I'm not only trading my own system, but I have money with other CTAs who I believe can do things and are doing things which I'm not able to do because I don't have the infrastructure set up to do that. I don't have the technology. I don't have the exchange connections. I'm not trading at the speed. I don't have their low commissions, things like that. And the way that they trade is very diversifying to my long-term trend following trading style. So to give an example, I'm not going to mention the name, but I have one CTA in my portfolio that is a short-term CTA with holding periods of 2 to 4 days on average. And this is just not where I am. And so they trade many round turns per million per year. They tell me that a lot of that is dependent on being directly connected to the exchanges and having, being self-executing and having low commissions and all that type of stuff. And that's great for me. And it's worked thus far. I have a very long track record, very good people, I think. And that's how I look at it. I would be very unlikely to invest in, in a CTA that is, around the same holding period as I am, trading about the same markets, with the correlation of 0.8 or 0.85 to what I'm doing, then I kind of would say, well, why would I do this? I can just use my own system and get roughly the same result.
Any thoughts, Jerry?
Well, I mean, I just have extreme thoughts. I'm kind of negative on, I never do short-term stuff. Never invest and never pay it no mind whatsoever. Never going to do anything long only in the stock market. Way too risky for me. And so I just think that I have my, trend following 10 commandments that, I'm not going to be happy with if I'm investing in somebody who is vol targeting or not trading all markets the same way, not trading the shorts the same way as the longs, on and on. We've talked about them. So, and so then I think I kind of have what I think is sort of robust ideas, and so that really limits my creativity. And so I find it probably difficult to think that I'm going to be happy with investing in other CTAs when I could just I'm only going to be happy with what I believe in, so why not just trade 50 different systems with 50 different entries, 50 different exits, etc., and sort of cover the range of all possibilities that all acceptable strategies to me would cover. So I guess I'm back to why invest in anyone else when I can kind of do it myself. And then someone would say, well, I understand, but if you added so-and-so into your portfolio, I've done the research and it would improve your performance and lower your risk. And I would say, oh yeah, but I've researched that CTA as well, and they violate some of my ideas. So I can't do that. And so at the end of the day, someone would say, well, I don't like your ideas that much, and you were wrong to exclude these people. And I would say, oh yeah, okay, you're probably right. It does look like I was wrong, and I shouldn't have had those negative attitudes about what those people were doing, but I did, and I do, and I can't stop myself. Does that make sense?
Yeah, it makes sense. I mean, I think it is important with all investments, not necessarily just whether you choose, how you choose another manager. It's important to have certain rules that you follow. As Larry Hite says, don't have goals, have rules. So nothing wrong with that, and stick to them. To answer your question, Brian, I mean, clearly, if you're looking for more than 3 trend followers, I mean, you've got 3 on the show that might work very well for you. But if you want even more than that, I think it is important, joking aside, I mean, I think it's important to fundamentally understand why they are different. Are they different because they trade different markets? Are they different because they have different, underlying models? I mean, there is a difference, in my opinion, between trading breakouts and trading, say, time series momentum or moving average crossover. I mean, that could add a bit of diversification. And even managers with high correlation can, from time to time, produce very high return dispersion. So, that's another thing to look at. But deep down, I mean, if you're in the trend following space, there aren't that many pure trend followers left, frankly. So I don't think it's going to be that difficult to find the managers you're looking to invest with. In terms of the short-term space, I mean, I understand why Maurici is doing what he's doing. And I think that can make sense for some people, of course, absolutely, to diversify it further into different niches. If you have rules like Jerry that says, no, I don't believe in that, then don't. But if you're an endowment or a pension fund, you probably have to do it. So that makes sense. But as a private individual, sure. I mean, if you can find managers you truly believe in and you understand why they make money and believe that they will continue to have an edge to do so, why not? So I'm kind of probably in the middle between of all of this. But I think the most important thing, Brian, is try and understand why you think they're different and why you think they'll continue to make money. All right. We have 2 more questions, so there's a lot in the mailbag this week. This is from Maurici from Portland. So now we're all the way to the US, which is nice. Let's see. In this day and age of so-called financial pundits and naively assume that they can predict the markets based on false macro and fundamental premises, it is refreshing to hear guys like you that have the humility of admitting that it is worthless to try and predict the future and instead follow trends by applying systematic rules. Given that one of your main principles of trend following is cutting your losses short, could you please elaborate a bit on what would be your typical stop loss in percentage terms once you enter a new position? Do you apply the same initial stop loss rule across all asset classes, or do you use specific ones for each asset class? So first of all, thanks for the question. This is actually something we've talked about on a number of occasions, but it's always good to get a question like this. I think we all, maybe not actually. Here's a little bit of a difference. So, on our part, at Dunn, we treat all markets equal. We actually don't use stop losses like the classical stop loss. I'll let Morris and Jerry talk about that. But I think there's nothing, I mean, you could take the one philosophy saying we treat all markets equal, and then you construct your portfolio. Of course, you don't want to trade, 95% of the markets in one sector and then 5% in a few other sectors. You want to have a well-diversified portfolio. So you can either treat them completely equal like we do, or you can do, as I know Moritz and Jerry does, which is looking at the construction a little bit of the portfolio in terms of whether there are more markets that are highly correlated and whether they should have a different allocation. So let me let you guys talk a little bit about that, and also in terms of the size of stop loss. Since we don't lose stop loss, I'm going to defer that also to Jerry and Moritz in terms of what's a sensible risk per trade to take.
So we're back to the ATR in one way or another, and maybe just an example, because I think what I picked up, he was saying, do we have a constant or an equal amount of distance percentage-wise from our entry to the stop, right? And maybe an example to understand this is, just imagine for a second that WTI crude oil traded at 100, and also imagine that 10-year US bonds traded at 100, and we got a new signal. Then, because they have different volatilities, crude oil generally being more volatile than 10-year US notes, the stop that I will have for WTI crude oil is going to be farther away from my entry point, right? Maybe at 90. Maybe 10% away, maybe 5% away. I don't know. It depends on the more recent average true range of the market. But it's going to be tighter for the 10-year notes because their average true range is generally smaller. So maybe that stop is at 98 or at 97 or something like that. And I'm now going to size my trade such that if the stop were hit, both will have... the impact will be an equal loss, so it's loss equalization, the same amount of money lost in percentage terms of my equity for both of those trades. This is how I look at that. But as you can see from my explanation, this means that this is not a constant thing. It's not 1% lower from my entry for all of the markets, or 2 or 3 or 5% lower. It depends on volatility, and it depends on recent volatility especially.
I'm sure we're in total agreement. I'll say it slightly different. I think for me it is 100% always consistent from the point of looking at how many ATRs.
Exactly. Yes. Always the same ATR.
Yes, always the same. 2 ATRs, 3 ATRs, 5 ATRs, 10 ATRs. That's the stop loss in all markets, longs and shorts. Asset classes? Yes. Markets? Yes. Bitcoin? Yes. Crude, Bitcoin,
same
Swiss
stuff.
franc. Yeah. Now, and the percentage loss of the AUM is always the same. So It's two different questions too. Like, okay, I've done the back test and I have my system. What kind of leverage do I want to use? And that's going to go right back to my average trade is when I take a loss, I'm going to lose 50 basis points, 20 basis points, 75, whatever your choice is. And that feeds right into your overall risk. And then that's the first choice. And the second choice, or maybe the first choice, is how many ATRs I'm going to give. And that's more of a not technical analysis, but a system decision. Because like I said earlier, I'm putting on a trade and giving it 1 ATR, your win percentage is going to be in the 20s or the 30s. It's going to be too low. Giving 20 ATRs, it's going to be high win percentage, but you're not taking small losses. So you got to move that in a little bit. And from a system point of view, what's the optimal stop loss placement? Don't want to take too big of losses, but I don't want to keep getting whipsawed in and out, in and out. So two different issues. How much of your bankroll are you going to lose when you take a loss, and how close is that stop loss going to be? It's just like your exit. Am I going to use a 100-day moving average, 200-day moving average, 20-day moving average? 20-day moving average is too close. It's not going to be profitable. You're going to get whipsawed. 1 ATR, too close. Same decision. Then the separate decision, when I do get stopped out on my stop loss, how much am I going to lose? Two different things you got to come up with, two different decision-making processes.
Yeah, and I think since you did ask about that as well, I mean, I think that often you will come across us saying trade small so you can stay in the game. But of course, as Jerry says, I mean, your risk tolerance is really your individual risk tolerance. But I think you'll find a lot of traders maybe risking 25 to 50 basis points overall for that market. That could be broken down in a few different entries with different look-back periods. But we're not advocating using, 3 or 5% risk per trade or per market. That's going to get you into trouble sooner than not. So yeah, just be careful with that. Final question. Now we head back to the shores of one of the Italian lakes. This question comes in from Michael, and this is more of a how to structure your business kind of question, I feel. Michael writes, I noticed from your comments that some of you do employ traders at your funds. Being fully systematic, why does there need to be this human element? Why not just program the computer to put in the orders from a business point of view? Why incur these personnel costs? So
I think he's right. There's no problem with doing that. And I think some of the markets, probably don't, you still have to make a phone call probably, and some of them, but a human being can sort of sit there and watch and make sure the computer's doing the right thing and hit the button to say go or just monitor. But yeah, I'm not going to argue against that. I'm sure some people do it and it works great.
Yeah. What about you, Moritz?
Same here. I mean, I produce a daily order sheet, which I send in by email, and that part of the process could be automated, no doubt about it. And maybe I should do it. There's that manual thing that I do every day, which I'm sure a clever programmer could take off my hands and just get automated. But then on the other hand, I don't mind doing it. It is really not time consuming. It's kind of like a 5-minute job, if that, when it forces me to look at the thing, have a look at the positions, what's going on. So I don't mind doing it. It's just my routine and my habit, which I'm very happy with. So there's no real massive reason at the moment to make me change that.
So like Jerry said, I get where you're coming from, Michael. You could say, yeah, I can save a little bit of costs on having personnel to oversee what the computer is doing. However, I would say that it can, from time to time, be a very good idea to have people oversee what the computer do, because the computer will only do what we put into it, and mistakes do happen. I've certainly come across stories of people where a change to their code suddenly produced outside size of trades which weren't caught in time, costing the firm, millions of dollars. We know from the recent books coming out about Renaissance technologies that even firms with that enormous amount of mathematical brain power behind them, that they had errors in their code. So nobody's perfect. I think from a business perspective, you could argue both ways. You can say, yeah, I can save some money on salaries. On the other hand, people who can view the trades before they get to the exchange can maybe catch something that might pay for their salaries many times. Who knows? The other thing I would say, just as like Jerry suggested, there are markets clearly where you don't need a human to add value to the execution. It's so liquid, and a computer can do that automatically, without a doubt. But there are smaller markets where clearly they're not liquid enough to just leave it to the computers, at least not in our view. So we're still firmly believer that you need to have a human person reviewing all the orders before they go in, and that's what we do. It doesn't take long, but it adds value, we think. We can see that from our slippage. Personal choice, of course, Michael, at the end of the day. I think you can argue both ways, depending also on what markets you trade. If you're trading liquid stocks, maybe not a big problem. If you're trading like we do, smaller commodities from time to time, execution does sometimes require a bit of experience and finessing to get a decent price. So anyways, hope that was useful in terms of response. Before we come to an end, it's been a long conversation today. We're already at 1 hour and almost 30 minutes. Let me quickly run. We didn't even get to the Louis Bacon story that came out this week about him giving back investors' money. But think about whether you have any thoughts on that, Jerry and Moritz. Let me just quickly run through the markets, or the performance, I should say, where we stand as of Thursday. And I actually think Friday was, so yesterday was probably a good day for most CTAs. But anyways, as of Thursday, the Beta 50 index was pretty much flat for the month of November, up 6.02 for the year. SocGen trend, completely flat, pretty much 4 basis points up for the month, up 6.04 for the year. SocGen trend down about 30 bips for the month, up 8.59 for the year. SocGen short-term traders index up about 67 basis points for the month of November, up 2.73 for the year. And the Bridge Alternatives index up 0.25% for the month and up 8.76 for the year. Any final thoughts? The news came out this week. Louis Bacon, after almost 30 years, sending back investor money, something he's done on a number of occasions through his career. Is this a sign that it's harder to being a quote-unquote discretionary global macro trader these days, back to where we almost started our conversation today?
I think it's hard. I think it's how much is it worth to you to keep going? He'll keep going. He said he's going to keep going with his own money. So it's always been hard, but is now the right time to be optimistic or pessimistic? That's the big question.
Exactly.
And I think I think what you touched on right there, Jerry, is quite interesting as well. And that is, he'll keep going with his own money. So maybe it just means that there are certain things we can't do today with, I don't know how many billions they were managing. But there still doesn't mean that you can't do other things, with a smaller base of AUM.
Oh, I took it a little bit differently. He's just got too much money. Yeah. Personally. Why should I wake up and have these headaches? And I don't care who you are and how you've been trading. It's, we love our clients. There's nothing like them, but they add to our burden. The market is bad enough. And so he's getting rid of some headaches regardless.
Yeah. Absolutely. That's a good point. All right. Well, on that note, we're going to wrap up this week's conversation. And as mentioned earlier, if you have any questions for us for next week, do send them in, info@toptradersunplugged.com. So from Jerry, more to me, thanks so much for listening. And we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us.